Welcome to video 6 of part 2 of the EA Tax Training free EA exam prep course for 2025. Tom here, back with you to discuss C corporations. Some of what you learn here will also be relevant when we look at S corporations in the next video. For now, though, let's get started learning about C corps. What we will cover in this video is C corps in general and an overview of Form 1120. Then we'll talk about the taxation of C corps and how they are taxed. Then we'll talk about forming a corporation, then distributions and liquidations. Then we'll talk about controlled groups and closely held corporations. And we will finish up by looking at schedules L, M1, M2, and M3. Our free resources from irs.gov, we've got two of them in bold here, Form 1120 and its instructions, and then IRS Publication 542, which does cover corporations. I definitely recommend you get both of those, and then there are a couple of other ones there as well if you are interested in those topics. As a recap, a C Corp, as you'll recall, is a separate tax-paying entity. Profits and losses do not pass through to the owners for tax purposes. So unlike a partnership or an S corporation, for example, where those profits and losses do pass through to the owners, and even the sole proprietorship, those profits and losses are on the owner's tax return, the C corporation pays tax itself rather than passing on those profits or losses to the owners. And then when the corporation distributes those profits to its shareholders in the form of dividends, those dividends are also taxable to the shareholders, and they are not deductible by the corporation. So this results in that double taxation of corporate profits. So the profits are taxed first at the corporate level. Then when they are distributed out, they are taxed again at the shareholder level. So the same profits are taxed twice. A newly formed corporation is a C Corp by default. So if you go to the State Secretary of State's office, you form a corporation, you don't file anything with the IRS, then you will be taxed as a C corporation by default. Of course, you have the option to elect to be taxed as an S corporation if you meet the qualifications. And of course, we'll talk about S corporations in our next video. The C corporation, though, files their tax return on Form 1120. So let's look at the Form 1120. At least we'll look at page 1 for now. So at the top here, we've got the tax year. So if you're not a calendar year, then you're going to put in your beginning and ending dates of your tax year. If it is a calendar year corporation, then you can just leave that blank. Then we have all the normal information. Then you will see the income section here. Remember, we've got those portfolio type of income included here, which is unique among the business returns. So you've got dividends and interest, etc. Then we'll go down to the expenses, and you can see the various categories. And if you've got things that are not on this list, you've got other deductions. And much like with a partnership, you will add a statement in order to list out those other deductions. And then when you come down, you're going to have taxable income and a total tax, your payments, and an amount owed or an overpayment. So this is a lot like the 1040 in that respect, because the C corporation is a separate taxpayer, just like the individual is. There are, of course, several other pages to the 1120. We will look at some of those as we go along, but of course, you will be getting your copy of the 1120 and looking it over as well. The filing deadline for the 1120 is the 15th day of the 4th month following the end of the tax year. So if it is a calendar year corporation, then that is due April 15th. Remember, there is this one kind of oddity here, and it's an exception. If the fiscal year of the corporation ends on June 30th, then they have to file by September 15th, which is the 15th day of the 3rd month following the end of the year. But any other year end, it is the 15th day of the 4th month. Of course, they can get an extension by filing the Form 7004. And just like the individual, that extension does not extend the time to pay the tax due. That is just an extension of time to file the return. Interest and penalties. Interest is charged on taxes that are paid late. The late filing penalty, much like individuals, is 5% of the unpaid tax for each month or part of a month, up to 25% of the unpaid tax in total. If it's more than 60 days late, then the penalty is the smaller of the tax due or $510 unless you can show good cause. And the penalty for late payment, much like individuals, is 0.5% of the unpaid tax per month, up to a maximum of 25% of the unpaid tax. So, how are C corporations taxed? That's what we will talk about next. The corporation pays a tax on its net income, and that rate is a flat rate of 21%. So there are no brackets like there are with individuals. It is just a flat tax rate of 21%, and it doesn't matter what kind of income it is. We'll talk about capital gains and losses later, but even capital gains are going to be taxed at 21%. And then when the income is distributed to the shareholders as dividends, it is fully taxable even if some of the income was not taxable to the corporation. So, of course, it is possible to have non taxable income, and the corporation will not have to pay their 21% on that. However, once it gets distributed out in the form of dividends, there's no way to distinguish how much of that was taxable versus non taxable. So, it is all just considered taxable, and the shareholders will pay tax on it at their tax rates. Accumulated earnings tax. So some shareholders of corporations, especially closely held corporations, want to avoid this double taxation problem. So what they will want to do is try to hoard or accumulate their earnings in the corporation and not distribute it out as dividends. So in order to discourage that and to punish those who do that, there is something called the accumulated earnings tax. So, what this is a tax, it's an additional tax of 20% of something called accumulated taxable income. And remember, these earnings, the same earnings, have already been taxed at 21%. And they're going to be taxed again here. 20% of the accumulated taxable income will be taxed. And of course, once they are finally distributed out to the shareholders will pay tax again. So this accumulated earnings tax really is a penalty, even though technically it is called a tax. So, what is accumulated taxable income? Well, you start the calculation with just regular taxable income. Then you are going to subtract some things. So, first of all, you're going to subtract income tax expense because federal income tax, of course, is not deductible by the corporation, but it is an actual cash outlay that they have. So, you're allowed to deduct that. Similarly, you can deduct any disallowed deductions. So you have all of those things that are not allowed as deductions under the tax law that are allowed for book purposes. When we're figuring out accumulated taxable income, you are allowed to deduct those again because it is still a cash outlay that you had. Similarly, any dividends that you did pay, you get to deduct those, even though dividends are not tax deductible. Same idea. It's like a disallowed deduction. You get to deduct it. And then finally, something called the accumulated earnings credit. So those first items, the income tax expense and other disallowed deductions and the dividends paid, those are pretty black and white. You can figure out what those are. The accumulated earnings credit is not so black and white. So what is it? It is the amount of earnings and profits that are retained for the reasonable needs of the business, less the net capital gains for the year. And the reasonable needs of the business is going to be based on the facts and circumstances. So, for example, let's say the corporation has a large debt that is coming due in the next year or two. Well, it is reasonable for them to retain some earnings in order to pay off that debt. Or let's say they have a large capital asset or a large capital project that they are going to have in the next year or two. Again, it is reasonable for them to retain some earnings in order to pay for those capital projects. So those are the types of things. When we say reasonable needs, you basically need to look at the corporation. What cash needs are they going to have in the near future? And anything that is considered reasonable will be this accumulated earnings credit. Now, of course, there are a lot of disputes between the IRS and corporations about reasonable needs. In some of these cases can end up in court. But this is at least the theory. And for the exam, this is the definition that you want to know. There is a safe harbor for accumulated earnings, and that is that a corporation can keep up to $250,000 of accumulated earnings, and it will not be considered excessive. So the IRS will not argue with you. If you've got up to $250,000 of it, after you go through that calculation, your taxable income, you subtract all those things. If that is $250,000 or less, then you're good to go. The IRS will not argue the point. That $250,000, though, is only $150,000 for service corporations in the fields of health, law, engineering, architecture, accounting, actuarial science, performing arts, or consulting. The idea is there that service type businesses are not as capital intensive. They don't generally need to hold on to as much money for large capital purchases and large capital projects. So their safe harbor is only $150,000. But let's talk about the $250,000 one and what the IRS might do. Let's say they go through that calculation to come up with the accumulated earnings, and they figure it out to be $450,000. What the IRS is likely to do is say, okay, $250,000, that's the safe harbor. So any amount over that, in this case, it would be $200,000 over the 250. That's what they would say you owe that 20% accumulated earnings tax on. That's how they would figure that amount. Next is the corporate alternative minimum tax. So this just started in 2023. Corporations with average adjusted financial statement income over the last 3 years of $1 billion or more are subject to a corporate alternative minimum tax. That tax is 15% of that adjusted financial statement income after subtracting out the AMT foreign tax credit for the year. So what are we talking about here? Adjusted financial statement income. This is more or less book income. It's not exactly book income, but that's the easy way to think about it. So in the corporate world, especially these very large corporations, there is this tension between book and tax income for the corporation. On the one hand, the corporation wants to show as low a taxable income as possible in order to pay the least amount of tax possible. So they want taxable income to be low. On the other hand, their book income, their financial statement income, for these big companies, they're usually publicly traded companies. So those are going to be available to the public and to the investors and to their lenders. Even if they're not publicly traded, those financials will be available to their lenders and to others who might want to invest in the company. So for that purpose, the corporation wants to look good. So they want to show as much income as possible. So they want to show high book income or financial statement income, and they want to show low taxable income. So what this corporate alternative minimum tax says is no matter what tax strategies that you have used in order to lower your taxable income, you are going to pay 15% of that book income that you're so proud of, that book income that you show to all of your investors and to all of your lenders. So that's what the corporate alternative minimum tax is. You will just want to remember that, especially this 15% amount. Corporate minimum tax credit. So for several years before this 2023 corporate alternative minimum tax came into play, there was no corporate AMT. However, there was a corporate AMT in 2017 and before. So it is still possible for a corporation to have older unused AMT credits that carry over to the current year. And so they can use those, and those are filed on Form 8827. So you just want to know that it is possible to have this corporate minimum tax credit, and that would be from a year in 2017 or prior. Special deductions and credits. So for the most part, corporations are going to follow the same rules as all other businesses when it comes to reporting revenue, and expenses. But there are a few items that are handled differently. So we are going to look at each of these. We've got the dividends received deduction, charitable deductions, capital gains and losses, net operating loss, and executive compensation limit. So first, the dividends received deduction. A C corporation can deduct a percentage of the dividends it receives from other corporations. In other words, it owns part or all of another corporation. It gets dividends from that corporation, so that counts in income, but they are allowed to deduct a certain percentage of that depending on the circumstances. If the C Corp owns less than 20% of the other corporation's stock, then they can deduct half of the dividends that they receive from that corporation, 50%. If they own 20% or more of the other corporation's stock, they can deduct 65% of the dividends that were received. If the other company is a member of the same controlled group as this C corporation, or if they are a small business investment company, they can deduct 100% of the dividends that were received. So, in effect, none of those dividends end up being taxable. We will talk later in this video about what a controlled group is and how you define that. For foreign dividends, if the company owns 10% or more of that foreign corporation's voting stock, then they generally can deduct 100% of the dividends received from that foreign corporation. However, the stock must be held for at least 365 days in order for that deduction to be allowed. There are limitations on the dividends received deduction. There are some exceptions. First of all, you can find those in Publication 542 and the instructions to Form 1120. We're not going to go over them here because they are just not likely to be tested on the exam. Then the other limitation is that the deduction is going to be limited to 50% or 65%, depending on how much is owned, of taxable income, ignoring any NOL carryover. In other words, they are not going to let you wipe out all or most of your taxable income with the dividends received deduction. You're going to be limited to 50% or 65% of your taxable income for that deduction. However, if you have any NOL carryover, we'll be talking about NOL coming up. But if you had an NOL carryover from a prior year, for example, you get to look at the taxable income before you applied that NOL when you are determining these percentages. Charitable contributions. A C corporation can generally deduct charitable contributions up to 10% of taxable income. You want to know that for the exam. So they can make charitable contributions and deduct them up to 10% of taxable income. And taxable income for this purpose means taxable income without taking into account all of these things. So you don't have to take into account the charitable contributions themselves. You don't have to take into account the dividends received deduction. You can pretend like that does not exist. You do not have to take into account the deduction for bond premium that was paid. You do not have to take into account any NOL carryover to the current year. And you do not have to take into account any capital loss carryover to the current year. So you look at your taxable income without taking into account all of those things. The corporation can deduct up to 10% of that amount. For property contributions other than cash, the amount of the contribution is its fair market value reduced by the amount that would not be long-term capital gain if it were sold at fair market value. In other words, that's a long-winded way of saying the deduction is limited to the adjusted basis of the property for non-long-term capital gain property. So, for instance, if the corporation is contributing inventory, for example, remember, inventory is not a capital asset, so they cannot deduct the fair market value of that inventory. They can only deduct their basis in the inventory. Similarly, you could have capital gain property that you are contributing, but if it's short-term gain, in other words, you haven't held it for more than 1 year, then same thing applies. You can only deduct the adjusted basis of that property. If it is long-term capital gain property, then you can deduct the full fair market value of that property. This reduction, where you can't deduct the full fair market value, that is going to be reduced to 50% if they're contributing certain inventory items for the care of the ill, needy, or infant. So if they got these certain inventory items, not capital gain property, but they are specifically for the ill, the needy, or the infants, then you still can't deduct the full fair market value, but you don't have to deduct only your basis. You get to deduct a number right in between the two of those. So you get half of the benefit of the fair market value rather than all of the fair market value. For any contributions of property with a value over $5,000, you do have to have an appraisal. Contributions of food can be made up to 15% of the corporation's taxable income. So instead of that 10% number, if you are contributing food, then it is 15%. And then any contributions that cannot be used in the current year can be carried forward up to 5 years as long as they do not increase an NOL carry forward. So if you've already got a loss that you're carrying forward, you can't increase that. But absent that, you can carry forward charitable contributions that are not deductible this year up to 5 years. Capital gains and losses. Capital gains for a C Corp, as we said, are taxed at the same 21% rate as other income. There are no favorable capital gains rates for a C corporation. And capital losses can only be deducted up to the amount of the capital gains. There is no $3,000 net capital loss allowed like there is for individual taxpayers. Net capital losses can be carried back 3 years and forward 5 years. But those carrybacks and carry forwards are always considered short-term capital losses. So if you are a C corporation, you might think, well, we don't have to worry about if it's capital gain or not because it's all taxed at the same rate anyway. But you do still have to worry about it. You do still have to track it because you need to know, particularly if you have losses, what those losses are, and then the amounts of the carrybacks that are related to that. Net operating loss. A net operating loss is simply when deductions exceed revenue for the year. However, the following rules do apply. A current year NOL cannot be increased by NOL carrybacks or carryovers from other years. In other words, if you had a $100,000 NOL carryover from last year, and then this year you had another $50,000 loss, you do not say that you have a $150,000 NOL this year. You do have a $150,000 NOL carryover in total, but you're going to keep it separate. $100,000 was from the prior year, $50,000 is from the current year. Also, remember the dividends received deduction can be taken without regard for the net operating loss. The deduction for dividends paid on certain preferred stock of public utilities can be taken without considering the net operating loss, and the deduction for foreign derived intangible income is not allowed. Don't get too caught up in those details. Just read them over. Remember, they're on the list, not something that is likely to be tested. For tax years beginning after 2020, no NOL carryback is allowed, but they can be carried forward indefinitely. But there is this exception. So for farming losses and losses from insurance companies other than life insurance companies, they can be carried back 2 years. So all other taxpayers cannot carry back their losses at all. However, all taxpayers can carry them forward indefinitely. An NOL carryover from a year beginning after 2017, so 2018 or later, can only be used to offset 80% of taxable income in the current year. So if you have a $150,000 NOL carry forward and you've got $100,000 of current year taxable income, you can only use $80,000 of that NOL carry forward to offset this year's taxable income. So your taxable income would end up being $20,000. The other $70,000 that you've got left would then be a carry forward to next year. An NOL carryover from a year beginning before 2018, so 2017 or prior, can be used to offset 100% of taxable income for the year. So the old NOL, you were always allowed to offset 100%. This was a change that came in the law to make it only offsetting 80%. So if you have one of those older NOLs, you are still allowed to offset 100% of current year income. And one of the big reasons for that is because those older NOLs can only be carried forward 20 years from when incurred. So there is an end date. So the IRS doesn't want a corporation losing their NOL because they weren't allowed to use it all and their 20 years ended up expiring. So if you got the older NOL, you can use it to offset 100% of taxable income. Newer NOL, you can only offset 80% of taxable income. Executive compensation. So this is only for publicly held companies that are always going to be C Corps. So publicly held companies cannot deduct more than $1 million per year in compensation to senior executive officers. That includes the CEO, Chief Executive Officer, the CFO, Chief Financial Officer, and the 3 highest paid individuals. This does not prohibit the corporation from paying them more than $1 million. It's just that they cannot deduct the excess over $1 million. So this rule, again, only applies to publicly held companies. It does not apply to any privately held C corporations. Estimated tax payments. As a tax-paying entity, a C Corp is subject to underpayment penalties and interest if it does not make estimated payments. So it's much like individuals. But no penalty will apply if the balance due for the year is less than $500. The estimated payments are due quarterly on the 15th day of the following months. Fourth month of the tax year, which is April 15th for a calendar year corporation. Sixth month, which is June 15th. The 9th-month, which is September 15th. And the 12th month, which is December 15th. As you will remember, for individuals, it's a little bit different. It's April 15th, June 15th, September 15th, and then January 15th of the following year. But for corporations, that last payment is December 15th. So you will want to remember those dates. There are 2 basic methods of computing estimated payments. So very cleverly, they are called Method 1 and Method 2. So method 1 is going to be based on the estimated income of the corporation for the current year. Method 2 is based on the actual tax liability last year. So with method 1, each installment is 25% of the tax that the 1120 for the current year will show. So you have to estimate how much tax you are going to owe. That's why they are called estimated payments. And then you need to pay in 25% of that amount each quarter. So that's method 1. With method 2, the amount of each installment is 25% of the tax shown on the previous year's 1120. Now, this is only allowed if the corporation filed a full year tax return the previous year and if there was a positive tax liability. But if you meet that criteria and you're not a large corporation that we're going to talk about, then you can use method 2. So you can base this year's estimates on the amount of tax that you owed last year. And if you do that, then even if you way underpaid, because maybe this year ends up being a lot better year than last year, as long as you paid in according to method 2, then there will not be any underpayment penalties or interest that are due. A large corporation, which for this purpose means they have at least $1 million of modified taxable income in any of the 3 prior years, may use method 2 only for the first quarterly payment. So for payments 2 through 4, any of these large corporations have to use method 1, but they will give them a little grace in the first quarter and say, okay, it might take you some time to get a good handle on what your tax is going to be for the year. So for that very first payment, they will allow you to use method 2. There are 2 alternate methods. You do not need to know these in detail. Just know that they exist and the type of taxpayers that they are appropriate for. So first is the adjusted seasonal installments method. And as the name implies, this may be advantageous if a large portion of the corporation's income is realized in a short period of time. In other words, if it is a seasonal business. So maybe you've got a ski resort or something, and they get the bulk of their income in January through April. And then the rest of the year, they don't have very much income. They can use this adjusted seasonal installments method. And then you can see there's this rule about how you can decide whether or not you can use that method. You can look at that if you want to. Again, wouldn't worry too much about it. Just know that this method exists and it allows that corporation to time their estimated payments according to the seasonality of the business. Next is the annualized income installments method. This is kind of similar, but it is a little different. So this may be advantageous if income fluctuates throughout the year. So not that it's necessarily seasonal, but that there are times of the year when income is higher and times when it is lower. And what this method does, again, is it allows the corporation to time their payments to be in line with when they are actually making their money rather than having to do it equally throughout the year. And in order to use this method, the annualized income installments method, they have to elect it by filing this form 8842. And no matter which method you're using, if you're using method 1 or 2, if you're using one of these alternate methods, these payments must be made using the EFTPS, the Electronic Federal Tax Payment System. Obviously, those are electronic payments. Our next topic is forming a corporation. Capital contributions. Capital contributions, whether or not in exchange for shares of stock, do not result in any gain or loss to the corporation. So obviously the corporation is receiving something, either cash or other property, but that's not income. That is equity to the corporation. So there's no tax on the amount of those contributions to the corporation. When a shareholder contributes cash in exchange for stock in a corporation, the shareholder's basis in that stock is the amount of cash contributed. I think that makes sense. When a shareholder contributes property in exchange for stock, the shareholder recognizes a gain on the exchange if the fair market value of the stock exceeds their adjusted basis in the asset, unless the exchange qualifies as something called a Section 351 non-taxable transfer, which we will be talking about here shortly. The fair market value of that property is also the shareholder's basis in the stock and the corporation's basis in the asset. So if you do not qualify for this Section 351 non-taxable transfer, then when you contribute property in exchange for stock, you are going to recognize a gain on that contribution to the extent the fair market value of the stock received exceeds the adjusted basis in that asset. It is also possible to get stock in exchange for services rendered. So if someone receives shares in exchange for services, the fair market value of the services rendered are taxable to the service provider and is also their basis in the stock. So this is common, for instance, in startup companies. They may be short on cash, but they need people to do work. So let's say you have an attorney who is doing some legal work for a startup corporation. They don't have much cash. So the attorney agrees to take stock in the corporation instead of cash. So what they have to look at is what is the fair market value of those legal services that they rendered? How much would that corporation, for instance, have to pay another attorney in order to do that same work? So that attorney then has to recognize that much income. So they treat it just as if they had received, for instance, cash for their services. So it is income in their legal business. And then the amount that they recognized becomes their basis in the stock. Section 351 non-taxable exchange, which we already talked about a little bit before. So remember, in general, if a shareholder contributes property with a fair market value greater than their basis in exchange for stock, then they are going to be taxed on that gain as if they had sold the property for the stock. What Section 351 does is, in certain situations, allows you to avoid that tax treatment. So no gain or loss is recognized if one or more persons contribute property solely in exchange for stock, if immediately after the exchange, those persons are in control of the corporation. And when we say person here, it could be an individual, could be a trust, could be an estate, could be a partnership, could be an association, or it could even be another corporation. But if one or more persons contribute property, and after that exchange, they are in control of the corporation, then there is no gain or loss recognized on that exchange. So, what does control mean? It means ownership of at least 80% of the voting power of all classes of stock and at least 80% of the total number of shares of all non voting stock. So, C corporations can have lots of different types of stock and what we call classes of stock. But when you look at it, if you want to know, are we in control or not, you're going to want to remember for the exam this test, this 80% test. They have to have at least 80% of the voting power of all stock and at least 80% of the total number of shares of all non-voting stock. The contributions that are made must be of property, which can include cash. Contributions of services do not qualify for this. The shareholders' basis in the stock and the corporation's basis in the property received is equal to the shareholders' adjusted basis in the property that was contributed. And then it is important to point out that this also applies to corporations who elect to be S corporations. So this is a corporation rule, not specifically a C corporation rule. So if you are forming a corporation, even if you elect S corporation status, Section 351 still applies. There are certain transactions that do not qualify for Section 351 non-taxable treatment. First of all, transfers to investment companies, which is just what it sounds like. It's a company that is set up primarily to invest rather than to run an actual business. Transfers in bankruptcy and similar proceedings, and stock received in exchange for the corporation's debt. None of those qualify for Section 351 non-taxable treatment. If cash or other property is received from the corporation in addition to stock, this is called boot, we've heard that phrase before, then gain is realized to the extent of boot received. So if the shareholder contributes some property, and not only do they get stock in the corporation back, but the corporation also pays them some cash, or the corporation gives them some other type of property, then the shareholder does have to recognize gain, but only to the extent of that cash or other property that is received. Boot does include debt obligations issued by the corporation. So if the corporation basically says, okay, you gave us this property, here's the stock, and then here's an IOU, and we will pay you this amount later, that IOU, in effect, counts as boot, and the shareholder will have to pay tax on that amount. If the property that is transferred by the shareholder is subject to a liability, such as a mortgage, which is less than the contributor's adjusted basis, the corporation's assumption of the liability is generally not considered boot and is therefore not taxable. So if the liability is less than the adjusted basis, then it is not boot and there is no tax. The shareholder doesn't have to pay any tax on that exchange. On the other hand, if that liability is greater than their adjusted basis, then the contributor recognizes a gain to the extent of the difference, and the contributor's basis in the stock received is reduced by the amount of the non-taxable liability that is assumed. So that's a lot of words on a page, but let's look at a couple of examples to see how this works. Example 1. Bob contributes a building with a fair market value of $250,000 to Corporation R in exchange for 100% of its stock. So obviously, Bob is in control after this exchange happens. Bob's adjusted basis in the building is $100,000, and it is subject to a mortgage of $75,000, which the corporation assumes. No gain is recognized on the exchange, and Bob's basis in the stock of Corporation R is $25,000. So he had an adjusted basis in the building of $100,000. If the corporation was not assuming any mortgage, his adjusted basis in the stock would be $100,000. But since they did assume the $75,000 mortgage, you have to subtract that. And so now his basis is only $25,000. Example 2. Same facts as above, except the mortgage is $125,000. In that case, Bob must recognize a gain of $25,000 and his basis in the stock of Corporation R is 0. So he has to recognize a gain because his adjusted basis in the property was only $100,000 and it had a mortgage of $125,000 that the corporation was assuming. So that's a gain for Bob. That's an economic gain. He's come out ahead there. He's come out ahead by $25,000. So he has to pay tax on that $25,000. And his basis in the stock is going to be 0 because he had $100,000 basis in the building. However, all of that mortgage was assumed. So the $100,000 of that mortgage that was not taxable to him was assumed, has to be deducted from his basis. So his basis in the stock is 0. Distributions and liquidations. Earnings and profits. So when dividends or distributions are paid out by the corporation, their taxability to the shareholder is going to depend largely on something called the company's earnings and profits, or E&P. E&P is defined as the corporation's economic ability to pay dividends. And E&P should be determined every year from the beginning of the corporation, and accumulated E&P should be tracked. So in other words, the very first year, you compute earnings and profits, which we're going to talk about how you do that. You compute it the first year. Then the next year, you compute it again, and you're going to add that amount to last year, and now that's your accumulated earnings and profits. Then the next year, you compute it again, and then you keep doing that every year. So you've got two types of earnings and profits. You've got current year earnings and profits, and you've got accumulated earnings and profits, and both of those numbers are important. And this concept of earnings and profits is also going to be relevant if the C corporation later makes an S corp election. So in our next video, when we talk about S corps, we are again going to be referring to earnings and profits. So you'll want to know this not only for the C corp portion of the exam, but also for the S corp portion of the exam. So what are we talking about? How do you compute this earnings and profits? Well, current year E&P is computed by starting with taxable income. So taxable income is your starting point. Then you are going to add some positive adjustments and you are going to subtract some negative adjustments. So you start with taxable income, you add some things, you subtract some things, and that will give you your earnings and profits. This is trying to determine the corporation's economic ability to pay dividends. In other words, you're trying to get to the true economic income of the corporation because taxable income is not that. Remember, there are some things where the corporation receives income, but it's not taxable. But economically, they still received the income. There are other things that the corporation spends their money on. They have an expense, but it's not tax deductible. So it lowered their cash, but it's not reflected in taxable income because you were not able to deduct it. So E&P is trying to figure out the economics of the situation. It's similar, if you're familiar with accounting, to retained earnings. It's a similar type of concept. So specifically, here's what you do in order to compute it. You start with taxable income, then you're going to add any of these things that you may have. Federal income tax refunds, not taxable, but they are an economic benefit to the corporation. So you're going to add those. Tax exempt income, same idea. You didn't include it in taxable income, but the corporation got the money, so we're going to add that. NOL deductions, this is something you deducted, but it wasn't actually a current year money out of pocket type of expense. It was a carryover from a different year. So we're going to add that back. Non-taxable life insurance proceeds. So if you have any of those, again, they were not included in taxable income. We're going to add those back. Those dividend received deductions. So you received all the dividends. That was the actual true economics. That's what you received was 100% of the dividends. But for tax purposes, as we saw, you got to deduct 50% of those or 65% of those or even 100% of those, depending on the circumstances. So to figure out your true earnings and profits, you're going to add those back. Capital loss carryovers, similar to the NOL carryovers, it's not a current year loss, so you add that back. And charitable contribution carryovers, same thing. Deferred gains from installment sales, so you sold the property this year, but you're not going to recognize all of the gain this year. So it wasn't all included in your taxable income. Some's going to be included next year and maybe the year after that. But economically, you sold it this year, so you quote unquote earned that income this year. So we include that in earnings and profits. And then non-taxable cancellation of debt. So if you had any debt canceled, wasn't taxable, we add that back. Then on the other side are the subtraction amounts, the negative adjustments. Federal income taxes paid or accrued, not deductible for federal income tax purposes, but they are an actual out-of-pocket expense that the corporation has, so we will subtract those. Expenses of producing tax-exempt income, again, not deductible, subtract those. Then you have all of these other non-deductible expenses, fines and penalties, political contributions, etc., and so forth, not deductible, but still were actual economic outlays that the corporation had, so they will be subtracted from taxable income in order to compute earnings and profits. Earnings and profits are also going to be adjusted for depreciation. The reason they are not on that prior list is because they could be either an addition to taxable income or a subtraction from taxable income, depending on the circumstances. So for E&P purposes, any tangible assets are going to be depreciated straight line over the asset's ADS recovery period. Remember, that's that alternative depreciation system. And if you'll remember, ADS is always straight line depreciation. And the recovery periods are not exactly the same as the regular maker's recovery periods. Remember, 3 years, 5 years, 7 years, etc. The ADS lives or recovery periods tend to be longer. So for E&P purposes, you're not going to have any of that accelerated depreciation that we have under the general depreciation system. It is all going to be straight line over this longer recovery period, these ADS recovery periods. So as a result, this is going to show lower depreciation in the early years of the assets recovery period and higher depreciation in the later years. So remember, with either system, you are still depreciating 100% of the cost of the asset. It's just that under the ADS, it's taking a longer period of time to do it. So in the early years, GDS results in higher depreciation amounts. And in the later years, ADS actually results in higher depreciation amounts. So when you're doing your E&P calculation, you're going to figure this out for each asset, and then you are either going to add to taxable income or subtract from taxable income in order to determine earnings and profits. If you claim Section 179 expense on an asset, then those assets are going to be depreciated straight line over 5 years. In other words, it doesn't matter what the recovery period of that 179 asset would have been if you hadn't done 179. It is just going to be assumed that it is a 5-year asset and it will be depreciated straight line over those 5 years for purposes of E&P. So why are we going through all of this? Well, as we said before, earnings and profits determines the taxability of dividends that are paid. So dividends are taxable to the shareholder up to the amount of the corporation's earnings and profits, both their current year earnings and profits and their accumulated earnings and profits. So what that means is you could have a negative E&P. That is possible. So you could have negative accumulated earnings and profits. But if you've got current year positive earnings and profits, then any distributions that you make, any dividends that you pay up to the amount of those current year earnings and profits is taxable to the shareholder as a dividend. If you have positive accumulated earnings and profits, then even if the distributions are greater than current year E&P, Since you've got accumulated positive earnings and profits, again, those dividends will be taxable up to the amount of that accumulated earnings and profits. Any distributions in excess of earnings and profits. So if you, in effect, burn through all of the current year E&P, all of the accumulated E&P, so you've distributed all of that out, those amounts are tax-free to the shareholder up to the amount of the shareholder's basis in the stock. So this makes sense. This is kind of like if you went out into the stock market and bought a stock. Let's say you paid $10,000 for some stock in the stock market, and then the corporation bought back your shares for $10,000. Well, there would be no gain or loss. You have basis in those shares of $10,000. They're just giving you your money back at that point. So there's no gain on that. So it's the same thing here. Corporations already distributed all of their earnings and profits. Now they're distributing more. Those amounts that they are now distributing are simply a return of the shareholder's basis. And so they are not taxable up to the amount of that basis. What if the corporation keeps making distributions in excess of even the shareholder's basis? That then is taxable capital gain to the shareholder. So again, think about buying stock in the stock market. If you bought stock for $10,000 and you sold the stock for $15,000, for example, the first $10,000, that's not gain, that's just giving you your money back. But that extra $5,000 above and beyond your basis, that is capital gain. So it's the same idea here. You got all your basis back. They kept distributing money. That is capital gain. The only difference here is if you sell your stock in the stock market, you don't own the stock anymore. Here, it may be that you do still own the stock depending on the circumstances, but it is the same idea. There are a lot of ways that a corporation can make payments to a shareholder. So we are going to talk about several of these. First of all, they can pay the shareholder wages and fringe benefits if that shareholder works in the business, which, of course, in a closely held or private corporation, the shareholders often do work in the business. The corporation can pay dividends, as we have discussed. The corporation can do something called a stock redemption and make a payment to the shareholder. Corporation can liquidate and pay out to the shareholder. The corporation can make a loan to the shareholder. They can pay rent to the shareholder. They can purchase an asset from the shareholder, or they can reimburse expenses of the shareholder. We're not going to talk about these last two. The purchase of an asset we did cover in a previous video, so we've got nothing to add to that. And if it's an expense reimbursement, then that is what it is. The shareholder had the expense and the corporation paid them back. There's no tax effect to that. But we are going to talk about the rest of these. Wages and fringe benefits. A shareholder who works in the business receives wages like any other employee. They pay payroll taxes, they're subject to withholding, they receive a W-2. So this is different than with a partnership or a sole proprietorship. They are on payroll. If it's a C Corp, they work in the business, then they are going to be on payroll. Also, the shareholder can receive fringe benefits tax-free, just like other employees. So if it is a tax-free fringe benefit to all employees, then it is also tax-free to the C corporation shareholder who works for the business. Again, this is different than partnerships and different than S corporations. Reasonable compensation. So the compensation paid to the shareholder employee must be reasonable. What some business owners want to do is to pay themselves a larger than normal salary. The reason they want to do this is to avoid paying out money as dividends, because remember, dividends are taxable to the shareholder and they are not deductible by the corporation, but the salary is deductible. So some C Corp owners will have the bright idea, well, I don't want to pay double tax. So I don't want to have to pay tax on dividends. So instead of giving myself dividends, I will just pay myself an exorbitant salary. So I'll get the salary. Of course, the salary is still taxable to the shareholder, but it's deductible by the corporation. So it will reduce the corporation's taxable income, so they will not be paying their 21% tax on the amount of that salary. So what the IRS says is, no, you cannot do that. You cannot pretend that what is actually a dividend is salary. So what is reasonable compensation? Well, it is dependent on the facts and circumstances, and it takes into account the experience and skill of the employee, the duties that they perform, and other factors. But salary paid to shareholders who do not even work in the business would clearly be improper. And it seems silly to even have to put that on here, but as you can imagine, this has happened. Corporation owners put family members on the payroll just so they can pay them salaries rather than having to pay themselves dividends. And then, of course, the salaries are deductible, and then the shareholder themselves can just take the money from the family member. So you have to have, if somebody's an employee of the business, they actually have to be an employee of the business, and they have to be working, and the pay that they're getting has to be commensurate with the services that are performed. As you can imagine, this is another area that is highly litigated. You have the IRS and the taxpayers disagreeing on what is reasonable compensation. For the exam, you're not going to have to decide, well, is this reasonable or not? You're not going to do anything like that. You just need to understand the concept that the C Corp shareholder has to receive reasonable compensation. They can't pay too much in order to get around paying dividends and in order to avoid that double taxation. Next, we have dividends, which of course are distributions to the shareholders from the earnings and profits of the corporation. And as we have said, they are taxable to the shareholder and they are not deductible by the corporation. Dividends of property other than cash. So distributions of property to a shareholder result in gain to the corporation to the extent the fair market value of that property exceeds the corporation's adjusted basis in the property. And fair market value for this purpose is the greater of the actual fair market value or the amount of any liabilities assumed by the shareholder in connection with the property. So this is the reverse of the assumption of liabilities that we had before. Here, you could have the corporation distributing out a property that is subject to a mortgage, and the shareholder is now going to be responsible for the mortgage. So when we talk about the gain, the fair market value means the greater of the actual fair market value or the amount of those liabilities. So if the mortgage is higher than the fair market value of the property, you have to use the amount of the mortgage as the fair market value in order to compute the gain to the corporation. This is considered a sale of the property to the shareholder. And do note that a corporation cannot recognize a loss on the distribution of property to a shareholder unless it is distributed in complete liquidation of the corporation, which we will be talking about here in a little while. So the corporation will have a gain if the fair market value is greater than their adjusted basis, but they cannot have a loss if the fair market value is lower than their basis. Again, they don't want related parties creating tax losses. Constructive dividends. A constructive dividend is when a corporation makes a payment to or enters into a transaction with a shareholder that, while it's not labeled as a dividend, it has the same economic effect of being a dividend. In other words, they're not calling it a dividend, but that's what it actually is. So this can be thought of as a disguised dividend. So here are some examples. First of all, the corporation paying the personal or hobby expenses of a shareholder is a constructive dividend. Remember in the first video when we said that corporations and their owners should not commingle their funds. You should have separate bank accounts, separate credit cards, etc. And that is absolutely true. However, in the real world, it happens all the time. You can actually have shareholders of corporations who take their personal credit card bill, hand it to their company bookkeeper, and say, here, pay this credit card bill. Well, those are their personal expenses. So if they do that, That is not a deduction to the corporation when they pay that amount out. That is a dividend to the shareholders, just like you gave the shareholder that same amount of money and then the shareholder turned around and paid off their credit card. It's the same exact thing. Same way with any personal expenses that the corporation may pay. You may have seen cases in the news where corporation shareholders had their company pay to have their personal residence renovated and to get new furniture and so on and so forth. Any of those expenses that the corporation pays is a dividend to the shareholder. It is not a deductible expense. Usually, the ones you see in the news is because they tried to treat it as a deductible expense. They got caught. And so now they're owing all the tax, et cetera, and very likely they are going to prison as well. But in any case, if the corporation does pay the personal expenses of the shareholders, that is a dividend. Similarly, hobby expenses. So sometimes the owner of a corporation will have a very expensive hobby and they try to write it off as a business expense. So, for example, a couple of cases I've seen have involved race car driving. Some of these corporate owners like to race cars, and maybe they put the name of their company on the car or something like that, and they try to write it off as a marketing expense. But the IRS says, no, that's not marketing. That is just a hobby, and you're trying to turn a personal hobby into a business expense, and they will not allow that. And so that becomes a constructive dividend. Next, loans to shareholders with below market interest. The interest that is not charged can be a constructive dividend. So if you got a loan to the shareholder, the corporation can do that. And we'll talk more about loans later. But if they don't charge a market interest rate, then the interest they don't charge is a dividend to the owner. Cancellation of shareholder debt is also a constructive dividend. So if the corporation loans the shareholder some money and then forgives that loan, that is a dividend to that shareholder. Next, transfers of property to a shareholder at less than fair market value. The excess of the fair market value over the value paid by the shareholder can be a constructive dividend. So let's say the corporation owns a building that's worth $300,000 and they sell that building to the shareholder for $50,000. Well, that shareholder just received a $250,000 dividend because that house was sold to them, obviously, way below the fair market value. So that is just as good as if the corporation had handed that shareholder a check for that amount of money. Next, above market rents paid to a shareholder can be a constructive dividend. We will be talking about that in a little while. And then unreasonable compensation can be a constructive dividend, which we have already discussed. Liquidating distributions. A corporation terminates upon the complete liquidation of its assets. So if it just goes out of business, liquidates its assets, corporation then terminates. The corporation distributes all assets to its shareholders and recognizes any gain or loss as if it were a sale of those assets. So you can do a liquidation in a few different ways. One thing you could do is you could just sell all of your assets and then take whatever cash is left over, pay off your debts, send the rest out to the shareholders. That would be kind of the easiest, cleanest way to do it. Then, of course, the corporation would have a gain or loss on the sale of all those assets, and that would be reported on their tax return. Often, though, especially in these smaller, closely held corporations, that's not what they do. They may sell some of the assets, but some of the assets they just distribute out directly to the shareholder. So when they do that, the corporation is going to recognize a gain or loss on that distribution. The shareholders are deemed to have sold their shares in the company for the fair market value of the property that was received, thereby realizing a gain or loss. The corporation cannot recognize a loss on distribution of property to a related party if the distribution is not proportional or if the property was received by the corporation in a Section 351 exchange within the last 5 years. So if you are going to give a disproportionate distribution to one particular shareholder, disproportionate to their amount of actual ownership of the corporation, then the corporation cannot recognize a loss on that distribution. Or if the property that was distributed had just been received within the last 5 years in a non-taxable exchange, this 351 exchange, then similarly, the corporation cannot recognize a loss on that distribution. If a corporation does a liquidating distribution, they have to do two things. First of all, they have to file a Form 966, corporation dissolution or liquidation, within 30 days of adopting a plan to dissolve and liquidate. So they file that with the IRS. Secondly, they must issue a Form 1099 div to any shareholder who receives $600 or more in the liquidation. What the combination of these two things does is lets the IRS know what's going on and lets them know which shareholders received how much in the liquidation. Stock redemptions. A stock redemption is when a corporation buys shares back from a shareholder. It differs from a liquidation in that the corporation is going to continue to exist. Generally, that redemption will result in a capital gain to the shareholder. It's treated as a sale of the stock to the corporation. So the shareholders got some stock. The corporation is paying them some money or giving them some property. In exchange, the shareholder is giving the company back that stock. So that is a capital gain to the shareholder. The purchase of the stock by the corporation is not deductible by the corporation. When a corporation buys their own stock back, that is called treasury stock, and that actually reduces shareholders' equity. It is not an expense. In certain cases, a redemption will be reclassified as a dividend, resulting in ordinary income. So, for example, if the redemption is made proportionally to all shareholders and does not reduce their percentage of ownership, it will be treated as a dividend. So Corporation X has 1,500 shares of stock outstanding. Shareholders A, B, and C each own 500 shares. Corporation X redeems half of the shares, 250 from each shareholder. A, B, and C now own 250 shares, and there are 750 shares outstanding. The ownership percentages have not changed. This redemption is a dividend. So what's going on here? Well, you've got these three shareholders who are trying to game the system here. They're trying to turn an ordinary income that would come from a dividend into a capital gain. So both before and after this redemption, these three shareholders still own the exact same percentage of the corporation. So prior to this redemption, they each owned 1/3 of the corporation. After this redemption, they each own 1/3 of the corporation. So they are just disguising a dividend as a redemption in order to get capital gain treatment for that amount rather than ordinary treatment that they would get from a dividend. So the IRS does not allow this. In some cases, a corporation can choose to partially liquidate, and they file a plan to do that. What that means is they are going to liquidate some of their assets, but not all of their assets, and they're not going to go out of business. Such a partial liquidation will be treated as a stock redemption rather than as a dividend for any non-corporate shareholder. So if you're a corporation and you are a shareholder in another corporation, if you get a redemption that is a result of a partial liquidation, that is ordinary income to that corporate shareholder. It's treated as a dividend. If you are not a corporation and you are a shareholder in the corporation, it will be treated as a normal stock redemption. Therefore, you can get capital gain from that. Loans to shareholders. Corporate loans to shareholders are allowed. It does, of course, need to be a bona fide loan, and there should be a written loan agreement. You want to use market interest rates because remember, if you use below market rates or you don't have any interest at all, that can result in a constructive dividend. You do want to make sure the corporate form is maintained. In other words, the loan needs to be approved by the board of directors if it meets certain criteria. So you want to do all of that. And the risk of not doing all of this is that the entire loan will be classified as a dividend. So, as always, when you're dealing with related party transactions, you want to make sure to dot your I's and cross your T's. You want to do everything right. And so the same thing is true of a loan to the shareholder. If you're just pretending it's a loan when actually it's a dividend, then the IRS is going to come in and say it's a dividend. You have to pay tax on it. Rent paid to shareholders. A shareholder can rent property to the corporation. Happens all the time, can be a great tax planning strategy. But the rents should be, of course, at market rates because above market rates can result in a constructive dividend. So let's say the owner of the corporation, the shareholder, they also own a building. And the fair market value of the rent for that building is $3,000 a month. And they rent it to their corporation for $7,000 per month. That extra $4,000 a month above the fair market value rent will be considered a constructive dividend to that owner. But as long as you use fair market value rent, there's nothing wrong with this. And this is a good way to actually get some money out of the corporation without it being a dividend. Because, of course, rent is deductible by the corporation. So they have to pay rent to somebody. They might as well pay it to the shareholder. Then the shareholder, of course, they're going to have to pay tax on the rent that they receive. However, they also get all the deductions. So they've got a rental property, so they can deduct their taxes and maintenance and depreciation, etc. And the corporation can deduct the amount of the rent. So this can work, can be a good strategy. But again, you're dealing with related parties. You want to make sure you've got all the rental agreements in place and that everybody is following those agreements and doing everything that they are supposed to do, just as if the rent was being paid to some third party provider. Now let's move on to talk about controlled groups and closely held corporations. Taxpayers will sometimes try to lower their overall taxes by splitting their businesses into separate corporations. So they may split it into all these corporations, and then they may have different agreements between the corporations. They might call it a management agreement or a service agreement or a rental agreement or something like that. And by doing this, they're trying to lower their overall tax liability. Well, in order to prevent this, and to better reflect actual economic reality, some groups of corporations are required to be treated essentially as one for many purposes in the tax law. So this is known as a controlled group. There are three basic kinds of controlled groups. You want to know these: parent subsidiary, brother sister, and combined group. So we are going to talk about each of these. This is another area of the law that can be very complex, especially if you're dealing with lots and lots of different corporations. But again, on the EA exam, fortunately, you are not going to have to deal with all those really complex situations. You just want to understand the basic idea here of a control group, what it is, and these different kinds, and basically how they work without getting into the weeds and the nitty gritty of everything. So we're going to look at each of these different types of groups. A parent subsidiary group, this is probably the most familiar concept. This is where Corporation A owns Corporation B. So it's a parent and it's a subsidiary. It is considered a parent subsidiary group when the parent company owns, directly or indirectly, 80% or more of another entity. So that is parent sub. If they own 80% or more, it is a parent subsidiary group. The parent may be the parent of multiple subsidiaries. So one corporation might own more than 80% of several different corporations, in which case that parent company is called the common parent because they're the common parent of all those different corporations. Members of a parent subsidiary group must file a consolidated income tax return. This is different than the other two groups. With the other two groups, they will be considered as one corporation for many things in the tax law, but they do not have to file a consolidated income tax return. For a parent subsidiary group, they do file. They file one tax return to report all of the income and expenses of all of the corporations in the parent subsidiary group. brother-sister group. A brother-sister group is when 5 or fewer individuals, estates, or trusts own a controlling interest in the group and have effective control. This exists when these two tests are met, both of these tests. The same 5 or fewer individuals, estates, or trusts own 80% or more of each company under consideration, and the same 5 or fewer individuals, estates, or trusts have identical ownership in more than 50%. So you have to meet both tests. So what does this mean? Let's look at a simple example. Adams Corp and Bell Corp are owned by 4 shareholders as shown below. This is not a brother-sister group. So let's look at this. Shareholders A, B, C, and D. This is their percentage of ownership in each of these corporations. As you can see, they own 100% of both corporations. So clearly, they passed the first test. These 4 shareholders own greater than 80% of both Adams Corp and Bell Corp. However, there is one more test. Their identical ownership has to meet that 50% threshold. So what does identical ownership means? Well, you go through for each one and you're going to take the lowest percentage. So shareholder A owns 80% of Adams, 20% of Bell. The lowest is 20%, so we're going to use 20%. Then shareholder B, their lowest of the two is 10%, and then C and D here, their lowest is 5%. So this is their identical ownership in these two corporations. It only adds up to 40%. That's below the 50%. Therefore, this is not a brother-sister group. Again, don't get too concerned about all the details. I'm showing you the example just so you can comprehend the idea. You are not likely to have to get into any of these type of calculations. They're just going to want to make sure you understand the concept. So with a brother-sister group, if you think about the others, the parent subsidiary, if you think of that as like a parent-child, this is brother-sister because they are owned by the same people. So each of the entities is owned by the same people. So they're like all children of those owners. And so they are brothers and sisters. So that is what we mean by a brother-sister group. And then our last group is a combined group. So if all we had was the parent subsidiary and the brother sister, there are some gaps that would come up, and you could arrange the corporations in such a way that you didn't meet the parent subsidiary rules and you didn't meet the brother sister rules, yet you still had control over all the corporations. So a combined group is when you have 3 or more corporations, each of which is a member of either a parent subsidiary group or a brother sister group, and at least one of those is both the common parent of a parent subsidiary group and also a member of a brother sister controlled group. So those are the rules. You will want to remember those rules, and let us look at an example. Alex owns 80% of York Corp and 90% of Sharp Corp. York Corp owns 85% of Trip Corp. This is a combined group because York and Sharp are members of a brother-sister group, and York and Trip are members of a parent subsidiary group. So each of these corporations is a member of either a brother-sister group or a parent subsidiary group. And York is the parent of the parent subsidiary group and a member of a brother or sister group. So that's the other criteria. One of the companies has to be the parent of a parent subsidiary group and a member of the brother sister group. So York qualifies for that. So that is a combined group. So note, without this rule, without this combined group rule, Sharp and Trip would not be part of the same controlled group, even though Alex controls both of them, because they have no direct parent subsidiary or brother sister relationship. So look at Sharp and Trip. Alex owns 90% of Sharp. So Sharp is in a brother sister group with York. York owns 85% of Trip, but Sharp and Trip are not part of a brother-sister group, and Sharp and Trip are not part of a parent subsidiary group. So Alex clearly controls all three of these companies. But if we didn't have this combined group rule, Trip would not count as a corporation that is part of the controlled group. So this is why we have this rule in effect. You can think about these, look at these examples, make sure you understand them. However, do not get yourself lost in all the possible combinations and permutations. As you can imagine, what if you had 10 or 12 corporations with all different ownership percentages and you're trying to figure all this out? It is very labor intensive and time consuming to do that. Of course, you're not going to have to do anything like that on the EA exam. So just make sure you understand the basics and understand the concepts and can answer some fairly simple questions about how these groups work. Closely held corporations. We actually saw this before when we were talking about at-risk limitations, but it applies to C corporations, so we are going to cover it briefly again. A closely held corporation is one where, if at any time in the last half of the tax year, more than 50% of the value of the stock is owned by 5 or fewer individuals. That is a closely held corporation. You will want to know that definition. The at-risk limitations apply to closely held corporations, just like they do to individuals. So losses are only allowed up to the amount of the corporate taxpayer's risk of financial loss. And those at-risk limits do not apply to non-closely held C corporations. So it is only closely held corporations that meet that definition that have to worry about the at-risk limits. We will now move on to looking at Schedules L, M1, M2, and M3. If you were with us in the partnership video, this is going to be very similar. There are some differences with partnerships, but a lot of the forms are going to look very much the same. On the Form 1120, the last page contains Schedules L, M1, and M2, much like with the partnership. Schedule L, of course, is the balance sheet per books. Schedule M1 is a reconciliation of book and tax income for corporations with less than $10 million in assets. Schedule M2 is a reconciliation of beginning and ending retained earnings. And Schedule M3 is, again, a separate form, and it is a more detailed reconciliation of book and tax income for corporations with $10 million or more in assets. So let's look at these schedules. Here's an overview. Again, you can see Schedule L and then M1 and M2. Let's zoom in here. We have, again, the balance sheet, beginning of year, end of year, going to list all of your assets, all of your liabilities, and equity. You may notice that the equity section is a lot different than with a partnership. With a partnership, it was just one line, capital accounts. Here for a corporation, we've got, what is it? I think it's 6 lines for equity. So first you have capital stock. So when stock is issued by the corporation, there's something called the par value of the stock. Often it's only like $1 per share or $10 per share or something like that. The par value of the stock goes under capital stock. Then you have additional paid in capital. So any amounts that were paid above and beyond the par value are called additional paid in capital. Next, you have retained earnings, both appropriated and unappropriated. So this is an accounting concept, kind of similar to that earnings and profits that we saw earlier. Appropriated retained earnings means that the board of directors has said this amount of retained earnings is not available to be paid out as dividends because it is needed. It is appropriated for some future need that we are aware of and that we are anticipating. So those are appropriated retained earnings. And then unappropriated retained earnings are retained earnings that have not been appropriated and they are available in order to pay out dividends to the shareholders. Then you have adjustments to shareholders' equity. That's just to pick up any miscellaneous type of adjustments that you may have during the year. Then we subtract out the cost of treasury stock. Remember, when you do a stock redemption, the corporation buys back their own stock. That is a reduction in equity. So this is where you show that. Then that comes down to the total liabilities and equity. Schedule M1 is that reconciliation of book and tax income. So you start with book income. You are going to list all of the book and tax differences, additions, subtractions, and you are going to end up with taxable income. Again, that is for corporations with under $10 million of assets. Then Schedule 2 is an analysis of unappropriated retained earnings per books. So you're going to say, what were those retained earnings at the beginning of the year? Then you're going to have your increases, your decreases, and show what were the retained earnings at the end of the year. And again, that will tie back up here to Schedule L, where we show your unappropriated retained earnings at the beginning of the year and the end of the year. Similar to the partnership, there are some corporations that do not have to file Schedules L, M1, M2, and M3. If the corporation has less than $250,000 of gross receipts and less than $250,000 of assets, they do not have to file those schedules. Those requirements are a little bit different than the partnership, so you'll want to be able to distinguish between those. If they are not required to file these schedules, they must enter cash and the book value of property distributions on Schedule K, line 13. We will look at that. So even if they don't have to file these schedules, if they did in fact make any distributions of cash or other property, they do have to list the amount of those distributions. And these schedules can still be completed even if they are not required. So here is Schedule K. So it's going to start by saying, are the corporation's total receipts and total assets less than $250,000? You're going to say yes or no. If it is yes, then you don't have to file those schedules, but this is where you will put in the amount of those distributions that were made. And this is just one small part of Schedule K. There is more to it than just this. Schedules M1 and M3, corporations must file Schedule M3 if they have total assets at the end of the year of $10 million or more. So this is much simpler than the partnership rule. Remember, the partnership was if you had assets over a certain amount or if you had gross receipts over a certain amount, etc. This is more cut and dried. If you have total assets $10 million or more, then you have to file M3. Consolidated groups have to include the assets of all members of the group. So this is one of those places where if you're in a controlled group, then you have to include all the assets in order to determine whether or not M3 is required. If the corporation is required to file the M3, then they must also file this Schedule B of Form 1120. So on the partnership return, it was Schedule C. On the 1120, it is Schedule B. And again, similar to the partnership rule, corporations with $50 million or more of assets have to file all of Schedule M3. Corporations with at least $10 million but less than $50 million can opt to complete only Part 1 of the M3 and then to file Schedule M1 instead of Parts 2 and 3 of M3. And if they're not required to file Parts 2 and 3, then they are also not required to file Schedule B. Any corporation can choose to file M3 even if it's not required, but if they do so, they have to follow these same rules. So let's look quickly at the M3. It's going to be very similar to what you saw before. So you're going to start at the top with some financial information, come down to list out your book income, your total assets and liabilities. And then the next page is going to start your reconciliation of book and tax income by talking about the income items. So very similar to what we saw in the partnership return. And then the last page is going to be the reconciliation of book and tax expense and deduction items. Again, similar to what we saw on the partnership. And then Schedule B, this is the one that on the partnership was Schedule C, but for the Form 1120, it is Schedule B. Again, it is check boxes that the corporation has to check. This gives the IRS some more information for things that they might want to look at in case of an audit. And that is going to do it for video 6. Go over the major concepts here, especially contributions, the 351 non-taxable exchange, distributions, just understanding what the control groups were. Watch it again if you need to. Study the slides and the form instructions and the publications. And in our next video, we will cover S corporations. So I will see you in video 7.